Exercise 2-16, we're going to analyze and journalize transactions. Previously, we learned to record transactions using this type of method. So notice you have your list of assets over here, your liabilities, capital withdraw. Then this company only has one revenue account and this company only has one expense account. So a natural way to keep track of this would be a spreadsheet. Now realistically, companies have way more than 3 different types of expenses. So just to keep track of your expenses, you might have 50 or even 100 or more columns for expenses. And companies usually have more than one type of revenue to keep track of. For instance, if we have a grocery store, we want to keep track of our fruit revenue, our vegetable revenue, our soup revenue, etc. And within the fruit revenue, we want to keep track of apples and versus oranges versus grapes. And even within the apple revenue category, you'd probably want to have a revenue account for each type of apple. So your number of revenue columns would get to be huge. So this method does not work well for anything except for the very, very smallest companies. So the way the majority, if not all, companies keep track of accounting records is they use the journal method, which means we're going to need a debit column and a credit column. So let's review some accounting rules. So when we're using this journal method, which everybody does, transactions are first recorded in the journal, which has no balances. So remember, this right here is our journal. It has a debit column and a credit column, but notice there is no balance column. So the journal is just a chronological list, which just means it's a list in order by date of all the transactions that happen for the company, but it has no balances. Rule number 2, transactions are later posted, which just means copied, to the ledger. And this ledger, when we're learning accounting, is usually in the form of these T accounts. Now the ledger and these T accounts have balances. So if you wanted to know how much cash the company has, you would not go to this journal because the journal does not have balances. Notice there's no balance column. So to know the balance of our cash account, we would have to look into our ledger, which is often in the form of T accounts. So again, the order that we journalize transactions or we record transactions, you put them in the journal first, and then later we post them to the ledger, which will have our balances. Some other really important accounting rules. Each transaction has to affect at least 2 accounts. Otherwise, the accounting equation will no longer be true. In other words, the accounting equation would not balance. So we have to have at least 1 debit and at least 1 credit, which is our next rule. Debits must always equal credits. And the last main accounting rule in this journal, to make things easier to read, we're just going to record our debits first and then our credits. And my accounting lab reminds us, record debits first, then credits. And often my accounting lab will have us include an explanation down here at the bottom. All right, so let's journalize some transactions. So on July 2nd, the company received $12,000 contribution from Brett London, the owner, in exchange for capital. Now, the book likes to talk about a 5-step process to analyze these transactions. Identify the account and the account type, decide if each account increases or decreases, and then figure out if it's going to be a debit or credit using our debit or credit rules. And then we record it in the journal. So I like to do this method too, except I like to just take 1 account at a time. In other words, figure out what account, the easiest account to figure out what type it is, and then figure out if it's going to go up or down, and figure out if that's the debit or the credit. So let's talk about this transaction. The company received $12,000 cash. And why did they receive it? It was a contribution from the owner in exchange for capital. So I like to analyze cash first because it's the easiest one for students to understand. So getting back to my accounting grid, cash is what type of an account? It's an asset. It's everybody's favorite asset because it's the easiest to spend. So now we have to figure out, is this cash going up and is therefore a debit, which is just left, remember, debit means left, or is cash going down, which would mean it is a credit, which means right. So getting back to the transaction, it says received $12,000. So the business is receiving $12,000, therefore cash is going up. And since cash is going up and cash is an asset, that must be the left side. In other words, the debit. So I'm going to choose cash here, and I'm going to put $12,000 as a debit because cash is going up. And as our accounting grid says, cash, which is an asset, goes up on the left side. Now, we have to figure out, well, what is the other account? Well, the transaction tells you, in exchange for capital. So what's going on here is the company's cash is going up. And remember, on the right side of the accounting equation, we have two main accounts, either owner's equity or liabilities. And remember, liabilities show how much of the assets others own, such as the bank, and then equity is the amount of the assets that the owner owns. So of that $12,000 that the owner contributed, how much or who owns it? The bank, in other words, others. Is it a liability? Or does the owner own it? Well, the owner owns it. And remember also, this is an owner contribution, also called an investment. And as you can see down here, our rules say that investments will increase equity. So our equity account is increasing, therefore that is going to be the credit. And then which is the equity account that we're going to affect? It's the capital account. So remember, all owner contributions, also called investments, go directly into the capital account as an increase. Now some of you might say, well, is this a revenue? No, because revenue is when we sell something. We did not sell anything in this transaction. So our capital account is going to increase. And the way they formally show the capital account is it's the last name of the owner, comma, capital. And again, I'm putting the $12,000 as a credit because capital is increasing. Remember, all owner investments, also called an owner contribution, increases equity. And the reason I listed cash first is because our rules say record debits first, then credits. Now we need an explanation. So the explanation will be owner contribution. Now we're going to scroll down. I guess I can't scroll down. So we're now going to go to the July 4th, paid utilities expense of $450. So notice this transaction, which is listed right here, is also repeated right here. So really, we don't need this window for now. So the company paid utilities expenses of $410. So again, I like to figure out what's the most easy account to figure out what's going on. So is cash involved? Cash is the easiest to figure out. So yes, it says paid utilities expense. So the company paid cash. So let's get back to our accounting grid. So we have to figure out, is cash an asset, liability, or one of these? Well, cash is an asset. All right. So now we have to figure out, is it going up and would be a debit, or is it going down and therefore a credit? Well, cash is going down because we paid. So the business paid, it's a minus. So cash will be our credit. Now remember, we can't list the credit first. We have to record the debit first. So I'm going to skip the first line. I'm going to go to the second line. That's cash. And we said cash is being credited for $410. All right. Since we know our debits must equal our credits, we know that the other account has to be a debit because we have a credit. So let's figure out what is being debited. Well, why did we pay $410? It's for utilities expense. And utilities expense obviously is an expense. So does the company have more expense and is a debit, or does it have less expense? Well, the company has more expense. So that's why we are debiting utilities expense, because we have more. It's increasing. And our explanation, let's see what we got here. Paid cash expenses. Okay, July 5th. Purchased equipment on account. Now notice it says on account, so cash is not involved. So we know we have equipment. Equipment is going to be involved, so that one's pretty easy to figure out. So let's start with equipment. So equipment is what type of an account? Asset, liability, or is it one of these? Well, it's an asset. It has a future value. It's going to be around for a long time. So then the next question we have to answer is, do we have more equipment or do we have less? Well, we have more equipment, so equipment is going to be debited. $2,200. And we know the other account, since debits have to equal credits, the other account must be a credit. But let's figure out what the account is. So are we paying cash? No, it says we bought it on account. So what does that mean? If we buy something on account, that means we are promising to pay later. So we now have a debt. So which one of these is a debt? Liabilities is a debt. And the type of liability that we're going to use for this is called accounts payable. Now you might be asking, well, why are we crediting it? Well, the answer to that is, do we have more liability and it's therefore a credit, the right side, or do we have less liability? We have more liabilities. So accounts payable, which is a liability, is increasing. Purchased equipment on account. Next, July 10th, performed services for a client on account. Performing a service on account means the customer is going to pay us later. So the customer is not paying us now. So if a customer does not pay us later, what must we record? We must record accounts receivable because they owe us money. So next we need to know is, or we need to figure out is accounts receivable an asset, liability, or one of these? Well, because in the future, the client is going to pay us off. It has a future value, therefore it's an asset. So now we have to figure out, is this accounts receivable? Do we have more accounts receivable or do we have less? Well, we have more. So AR, accounts receivable, is going to be our debit account. So accounts receivable, $2,800. Now we have to figure out, well, what's going to be the $2,800 credit since debits have to equal credits? Well, why does this client owe us money? Well, we performed a service. So in other words, we sold something. So which one of these accounts is used to keep track of when we sell something? Well, that's a revenue. Next, we need to figure out, do we have more revenue or less revenue? We have more revenue. We made a sale. So that's why we are crediting revenue. And it's probably going to be called service revenue. There you go, service revenue. And our explanation is we perform services on account. So this is an unrealistic explanation. In the real world, you won't want to add the name of the person, the customer, who now owes us money. So you would say, John Doe owes us $2,800. July 12th, borrowed $7,500 of cash, signing a note payable. Let's do cash since it's the easiest. So cash, is that an asset, liability, or one of these? It's obviously an asset. Next question is, do we have more or less cash? Well, I said we borrowed cash, so we have more cash. So that is why we're going to debit cash for $7,500. And then why did we get this cash? Well, we borrowed it. So if we borrowed cash, we now have debt. Debt is a liability. So do we have more debt or less debt? We have more debt. That's why we're going to we're going to credit. Credit means right. We're going to credit a liability. And which liability is it? It's notes payable. So the difference between notes payable and accounts payable is notes payable is more formal, so it's in writing. Another reason you're going to have to get it in writing for notes payable is you're going to have to pay interest. And anytime you're going to have someone pay you interest, you better get it in writing. So our notes payable is increasing. We've got $7,500 of debt, additional debt. Borrowed cash by signing a note. July 19th. The owner, Brett London, withdrew $750 cash from the business. So I like to start with cash since it's the easiest to understand. You should understand now where cash is over here. Cash is an asset. So because the owner withdrew $750 cash from the business, does the business have more or less cash? Well, the company has less cash, so cash will be credited. And remember, we have to record debits first, then credits. So the debit will be the first one, so we're going to skip that line. So cash is going down, therefore cash is being credited. Withdrawals by definition means the owner is just taking money out to spend on himself, like his cable bill or to buy groceries, etc. So let's look at withdrawals. Here's our withdrawals account. Do we have more withdrawals or less withdrawals? Well, the company has more withdrawals, so that's why we're going to debit withdrawals. $750. And the way they formally show the withdrawal account is they have the last name of the owner, comma, withdrawals. And for the explanation, owner withdrawal. July 21st, we purchased office supplies for $860 and we paid cash. So cash is usually the easiest one for people to understand, so let's analyze cash. Cash is an asset, and since the company paid cash, we have less cash, so cash is going to be the credit account. And again, record debits first, then credits. So I'm going to skip the first line. Cash is the credit, $860. Now debits have to equal that, so we know it's going to be $860 debit. But why did we spend this cash? Well, we got some office supplies. Will the office supplies have a future value? Yes, they are an asset. So do we have more office supplies or less? We have more. Therefore, that's why office supplies is going to be debited. Purchased office supplies with cash. And our last transaction, paid the liability from July 5th. So let's look back at July 5th. On July 5th, we purchased some equipment, but it was on account. So we owed $2,200. So let's go back up and look at the July 5th transaction. So on July 5th, we increased our equipment account. And then we increased our accounts payable. So we had, at that time, we listed $2,200 under accounts payable. We are now paying off this accounts payable. So let's scroll down to our journal section for July 27th. We paid the liability from July 5th. Let's start with cash. Cash is an asset. Now, do we have more cash if we're paying something? No, we have less cash. So cash is going to be the credit account. So we have to list that second because debits are listed first, then credits. So our cash is going down, and then I already forgot the number. So let's look back on the July 5th transaction. So we owed $2,200. So we're paying $2,200. Now, what happens to that accounts payable when we pay it off? So let's go back here to our grid. So remember, accounts payable is a liability. Back on July 5th, we increased the liability. Now that we're paying it off, we had to remove that liability. So our liabilities are going down. Therefore, we're going to lower accounts payable with a debit. And our explanation is paid cash on account. It just means we're paying off some of our accounts payable. And that's it. Now don't forget, do the other version with the random numbers.